Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 267th VideoCast podcast for the week ending November 28th, 2024. Happy Thanksgiving, everyone. Very, very grateful for your consistent support and all the amazing stuff we've gone through together over the years. And I'm going to make this one much better than I expected. The secret to happiness is low expectations. I was shocked the amount of data out there this week. So as much as I thought this would be a 30-minute deal, this is going to probably be a little bit longer and a lot more value. And that's what we try to do each and every week. So as always, family first. This is Mimi and Annabelle. They got this amazing Spanish water polo stuff from Annie Esbar. She won a gold medal in water polo in the Paris Olympics in 2024 for Spain. So these are the type of folks they're training with in California. Super exciting and very kind of Annie. These pictures here, the girls heard about this amazing teacher who was trying to raise money and get help for Friendsgiving for her students who may not get a Thanksgiving. So they took it on their own initiative to help make it happen. Here are some photos of the kids. This one we'll get to in a second. These are not the kids. These are the kids. These are the kids and some of the food they were able to make. And get involved with time and helping them out with their donation drive. And the teacher wrote back, "Thank you so much for the donation and the time. My students were so happy. Many of them have never even tried things like dark purple grapes, blackberries, pomegranate, or raspberries. They hesitated to take one because they didn't know what it was. But I told them to try it, and they loved it. And they also had freshly made juice with Italian parsley, lime juice, chia seeds, and monk fruit sugar. Also, they learned how to make spring rolls without being in a kitchen so they can try it at home, even if they're homeless or living out of a motel. They also use flowers from school's edible garden. Spring rolls are so easy to make and so healthy. You made a big difference for these kids today. They feel very loved and full of goodness. Thank you again, Miss Ellis." So really proud of my girls, Mimi and Annabelle, for getting involved in this in a big way. And, it goes to show on a day like this, we all have so much to be thankful for and grateful for. And we have to keep in mind that not everyone has that. And when you can, to try to lend out a hand up and a helping hand for people and be grateful for what you have and also be willing to help. So really proud of them more than anything else for that. I want to recognize two of our longtime viewers, loyal viewers, Alan Wall and his friend Rick, longtime friend and client Rick, and super athlete Rick, came up. They were in Connecticut. They came up to the house in Ridgefield. We sat there and talked and caught up on all the episodes and all kinds of stuff, market life, everything else. And then I said, look, you got to try the beef rib at Hoodoo Brown. And we drove over here in Ridgefield and we all got the beef rib and they were blown away. And thanks, they actually hosted me in my own town. They went in I was very, very kind to them. So we had just a wonderful time. That's Alan. He's an investment professional at Stifel, and Rick is a professional, also an investment professional, a very long storied career and businessman, very successful businessman as well. And so when you get up to Ridgefield, try and do that. And we're live from Ridgefield today. This is going to be the last one from Ridgefield for a long time. Potentially won't be doing any podcasts from Connecticut until we're in the 400s or 500s episodes. So we start the journey. I'll be splitting time, probably 10 days a month in New York and 20 days a month in California and Orange County. So we're excited. That starts on in just a few days. The girls will go out there. I'll meet them out later. And that's that. So let's see, what else? Did we get all these? Yeah. Okay, moving on. Super excited and thankful to Christian Dagger and Preston Mizell for having me on Stuart Varney this week, but mostly to Stuart, who invited my gals Mimi and Annabelle, number one, on set. They didn't have to wait in the green room. They actually stood on set and watched the show And then Stewart invited them over for a picture, which was so generous. And that's, he's a busy guy. 3 straight hours, right in the commercial break, they ran over, they got these great photos. And that's also Madison Allworth. She's a star over there, correspondent, rocking and rolling. She was so generous with the girls. Awesome stuff. And then we got to meet Elon Musk's mother in the green room. She was on right before talking about her book and her professional modeling career. I think she had 20 covers this year. And she was so nice. I love talking to her about all the stuff that she's doing and obviously the stuff that Elon is doing and China and all over the world. Super exciting. And Preston for taking it, organizing this picture, and for May for being so kind to do this. The girls can't stop talking about it. And May also autographed her new book, Woman with a Plan. May Musk, you definitely want to pick it up on Amazon. Autograph that to the girls as well. Super amazing lady. This was us in front of the Christmas tree at Fox. This was probably the most fun day of my entire year, being in the city with the girls. This is Bryant Park, right next to our place there. That's the ice rink. That's Annabelle and the tree and Bryant Park Hotel right over there. And then Bryant Park Grill right across the street. And we got to sit next to the Christmas tree. I mean, there's nothing like New York City at Christmas time. What an amazing couple of days we had there. And then as it goes, let's get down to the media here. We talked about some very important things because overnight, before getting on with Stewart, President-elect Trump announced that he was going to tariff Mexico and Canada and China. And I think it's important here to listen in and separate the facts from the perception of the facts, and we got a chance to go into that with Stu, so let's listen in here.
With me now is, I will check the markets first of all, please. Split decision here. Dow's down 218 and the Nasdaq is up 109 points. With me now is Great Hill Capital Chairman Thomas Hayes. Trump wants to impose a 25% tariff on Canada and Mexico, and just to stem the flow of drugs and migrants across the border. How come, now, this is major tariffs he's proposing here.
Yeah.
How come the market's not selling off?
Well, I think 2 things. Number one, it looks like not only Mexico, but also Canada is going to pay for that wall is happening. I think, look, Canada's had a free ride. All the people that we've rejected from coming in go through Canada. It's like a sieve. So this is his ask. This is the starting point. It'll come down. If you look at the China tariffs overnight, he said 10% more, but there was a caveat. Because you're not imposing the death penalty on fentanyl smugglers, we are putting this 10% tariff. That's a lot lower than advertised during the campaign, isn't it? So China's stocks were up overnight on that. It's more moderate. And I think this whole fear about tariffs, Stu, we are at the lowest tariffs in more than a century. Okay, we had higher tariffs under Clinton, under Carter, than we have under Trump. 2 to 3% of all imports we have duties on. They had 4 or 5% under Carter and under Clinton. And going back to 1918, everyone says, oh, tariffs, holy smoot, this is going to be a huge problem. He's going to put tariffs and we're going to crash. Tariffs in 1980, right after the Spanish flu, were 5% of all. They grew for over a decade to 20% before Hawley Smoot. So there was a decade of increasing tariffs with a huge economy, with a growing economy before Hawley Smoot. So this is a complete misnomer of history that the minute you put any tariffs on, the market crashes. You have a 10-year runway at least, and we're starting at a much lower base than we did in 1918.
You brought some stock picks with you. I want to concentrate on just one, and that's Generac.
Yes.
I have a Generac generator, and I kind of like this thing.
No question about it. Everyone needs a Generac generator. We came on the show in August. The stock was $137. It's all the way up to $189 today. Some 40% since then. This is going to go not only over 200, it's going to keep pushing higher, 250. This thing was close to a $500 stock during COVID. They have 70% of the home standby generator system, so you're not the only one that has it. But you've got more hurricanes, you've got more strain on the power grid. They're the only game in town. It's like the Kleenex of home standby generators.
Kleenex of home standby, very good one. A nice analogy there. Tom, good to see you. Thanks for being with us. I hope you and your family have a wonderful Thanksgiving.
You too, thank you.
Staff.
And we're back, and we're going to get to that data chart later so you can see what I'm talking about. and the data behind 100 years of duties on imports and how we are at that 100-year low. So there's a lot of runway. And then I got a chance to join Liz Neo. I want to thank on CNA, which is the BBC of Asia and based in Singapore, huge audience, and Audrey Tay for having me on, the producer.
And we have Thomas Hayes, Chairman and Managing Member at Great Hill Capital, joining us for more now. Thomas, let's just help us take a look at why investors are pivoting back to cyclicals and stocks and those names tied to the economy, which of course help to push the S&P 500 higher overnight.
Well, Liz, this is a theme that started over the summer. And basically what you've been seeing since the beginning of the year is the Magnificent Seven, or large cap tech, had 50% earnings growth, and that is decelerating to about mid-teens earning growth by the beginning of 2025. Whereas the unmagnificent 493, or the economically sensitive stocks, as you referenced to their earnings growth has been accelerating. It was negative in the beginning of the year, and it's turning positive, and it's going to move into mid-double digits next year. So I think people want to start to slowly add into the economically sensitive stocks. They're more cheaply valued, and their earnings growth is going up versus going down.
Yeah, and so with that comes the rotation out of big tech. At the same time, the tech names, they continue to say that the AI theme is very much intact still, despite some worries in the semiconductor sector. How are you approaching investing in the sector? And also, the sort of approach that the new Trump administration could take with the tech industry?
Yeah, well, I think people were eager to get through the NVIDIA earnings report. It missed the whisper numbers. The guidance was a little bit mixed, but it was good enough to get the market through. The issue with NVIDIA is there was a time that as the stock went up, it became cheaper because the multiple was coming down due to growth in profit margins. That's no longer the case. The profit margins have stopped increasing. The growth is decreasing. The multiple is going up. So while they could probably have maybe a couple quarters of some stock appreciation, I think a lot of that's slowing down, and managers, as they get into the next year, are probably going to have to lighten up as it's become a larger and larger part of their portfolio. As far as big tech, I think people are finding other opportunities. If you looked at Deere today, was a big gainer, but the biggest gainer, you mentioned the Dow, you mentioned the S&P, you mentioned the NASDAQ and the difference in performance, but the biggest performer was small cap stocks. They were up 1.5% today. And those are the biggest bang for your buck moving forward. You get the most amount of growth over the next year for the least amount of multiple. And I think you're starting to see more and more people broaden out, looking for opportunities under the surface as maybe the indices gains led by large tech start to slow down a little bit, or certainly normalize relative to the past 2 years.
Yeah, and actually we see small cap, starting to pick up pace as, calls for a Trump victory kind of firmed up. And so, when we look at the so-called Trump trades, it has been a bit of a volatile movement. I mean, right after the election, it was really good. Of course, could be fueled by sentiment as well. But then we saw a bit of softness, and now it's back up. Where do you expect them to go from here? And what is it exactly that investors are searching for right now?
Yeah, Liz, well, it's interesting because there were two Trump trades in Trump 1.0. So you had the election in November of 2016, followed by the inauguration in January 2017. What happened after the election was different from what happened after the inauguration, meaning the dollar rose right away after he was elected and bonds fell, yields went up. But after the inauguration, the dollar re-weakened and bonds got bid and yields came down. And I think the two biggest surprises of 2025, Liz, are going to be yields come down and the dollar goes down. And right now, people are positioned in the exact opposite way, and we might be at the peak of that. The other thing that people expect from a Trump administration is that energy will do exceptionally well. That was not the case in Trump 1.0. If from the election to the inauguration, energy stocks did extremely well. After the inauguration in January, energy did very, very poorly in that first year of the Trump administration. As you get more supply, margins are compressed, earnings power is compressed for the energy companies. And I'll tell you another thing that did extremely well, that again did poorly after the election and did very well after the inauguration, was emerging markets stocks. They did extremely poorly once he was elected and extremely well from 2017 to 2018 after he was in office. You had one of the biggest rallies in emerging market stocks in the shortest period of time. And that's including he was elected on tariffs, he was elected on protectionism, and those stocks still did well. So we're in for a lot of positive surprises in 2025 that people may not yet be positioned for.
All right, Thomas, appreciate your insights and helping us look ahead of what we can expect when the inauguration rolls around. Thomas Hayes, Chairman and Managing Member at Great Hill Capital.
And that's that. And then it says far more, this is Peter Lynch, quotes of the week. Far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. That's an important thing to remember, because you got this cadre of folks that are always calling for corrections for the last 15 years and kept people out of the market, missing hundreds of % of return, doubling, tripling their money, and potentially retiring earlier. We had a late night. The club had the anything but Thanksgiving dinner last night, so I was up till 2:30 a.m. doing the article of the week for you guys, which I think you're going to find great. And my lovely wife drove out to Dunkin' to get us some. By the way, they're not paying me. I'm not a Starbucks guy, so I keep it simple. I grew up in Jersey. Got me this beautiful iced coffee so I could get this podcast out before our guests come. And whether we're talking about stocks or socks, I like buying quality merchandise when it's marked down. That's from the all-time great Warren Buffett, who I've learned so much from over the years, and we followed that as well. And the key thing here that I think people get messed up with value investing and or quality value and growth are joined at the hip. The key is quality merchandise, growing earnings, growing cash flow, and then what do you pay for that growth? What do you pay for that? Because far too often people get caught in businesses that are, value traps and only buying it on the basis of liquidation value with no plan for reacceleration of growth, and that's where people get tripped up, or that's where a negative connotation comes from value, and you have to be able to distinguish the two. And then finally, Buffett, your mind is like a bank. What you deposit is what you can withdraw. And I think people always ask me, like, well, how do you get into the career? How do you do this? Why is Buffett so great? Blah, blah, blah. It's because we read more than anyone else. I mean, and it compounds over years, just like money. So I can see things in 2 minutes because I have 20 years of data points, 20 years of doing it wrong, doing it right, overcoming obstacles, seeing how things work, seeing how things rhyme versus repeat, seeing patterns. That's the biggest thing that you get over time and experience. So you just have to put in the time. And the only way you're going to be willing to put in the time is not if you're looking to get rich overnight, but if you absolutely love what you do and you feel like you're hopping, skipping, and jumping to work every day, going through a treasure hunt, which is exactly what I feel like every single day. So you got to love what you do to be great at it. So let's get to the charts of the week. This is where I was shocked with how much data we have to cover this week, but it is so good and it's going to set us up for the next 12 plus months. And I'm super excited about that. So stocks do better under re-elected presidents early in their second terms. So in theory, we have a re-elected president in President Trump. There was a 4-year hiatus, so that year 1 and year 2. This is consistent with the presidential cycle in general, where year 1 tends to be okay, a little bit weaker in the first half of the year, followed by strength in the second half. And then that midterm year tends to be the weakest of the 4-year presidential cycle. So I think in next year, our kind of base case is like a 7 to 13% on the S&P type of range, and but so much easier to make money because all the big gains will be under the surface in the non-Mag 7. So those stocks can be up 40, 50, 70, some 100%, and the indices subdued, and that's the environment where we can absolutely take advantage of it. So I'm very, very excited. This is the Russell 2000 relative to the Russell 1000 seasonal patterns since 1979. So the 2000 really picks up in December and into the first quarter. That's small caps. We're excited about that. They're also breaking out here. This is all-star charts, just a standard small cap index. And then biotech, which is really interesting because we have exposure to the XBI. If you remember, we bought it in the hole here in 2022. It immediately rallied. We thought we were geniuses. Then it consolidated sideways, went back and retested. We held our ground. We added more in the hole, and now it's breaking out. And what's interesting you see going all the way back is this converges with small caps taking off. We are going to see a massive catch-up trade in XBI in 2017 and beyond, just like you saw in the early Trump presidency as well. Risk appetite comes back, the game gets on. So not only are small caps going to keep pushing higher as they did during that period, but biotechs are going to catch up, and we're going to mint on both sides. Super excited for those of you who are with me. US versus China equities. This chart was posted by Scott Granis to show the American exceptionalism, and we 100% agree with American exceptionalism. However, what I look at and where I've made my career is in capturing benefits of dislocated periods and divergences. That is my knitting. I do it very well in my view, and I think what you see here that's more interesting than showing the U.S. exceptionalism is the catch-up trade, how China both overshoots and undershoots the U.S. from time to time. And the last time we had this dramatic of an undershoot was in 2001 to 2002, which I continue to reference, and you get this double bottom down here, and then it starts to break out and checks back, and then you have one of the most parabolic moves in China and emerging market equities in the shortest amount of time in history, also under a Republican administration, by the way. By the way, I mean, U.S. stock markets do exceptionally well under Democrat presidents as well. So I'm not saying that to make a partisan point. I'm saying that to make a point that the hawkishness expectations are sometimes overrated. And this is setting up exactly like that period to rhyme like it's going out of style and to catch up and then overshoot the U.S. performance. And I think we're going to see that. And I think that's going to be one of the biggest surprises of the Trump administration, very similar to the catch up we saw after the elected and then inaugurated and then caught up to the U.S.-China performance and then overshot. So that's a good thing. The 10-year yield seems capped at 5, so Besant got elected and then it rolled over. The interesting thing about Besant, that was a coincident, not a causal thing, by the way. What was underlying it was the excessive positioning that we've covered in recent weeks as it relates to the commitments of traders report and people the most offsides on the bond trade, hedge funds the most short bonds that they've been since October 2018, which preceded one of the largest bond rallies, compression of yields that we've seen in many, many years. And I think we're nearing that same type of thing, and this has come in even a little bit more. Economists upgrade China's exports and growth outlook. Dollar advance may be tempered by Besant nomination. This has nothing to do with the Besant. That's just coincident. It's helpful. It doesn't matter what the catalyst was going to be. If it was going to be Russia lobbing a bomb into the Ukraine and bonds get bid, it doesn't matter. The positioning was so offsides that the market disciplines that type of excessive behavior, and that's exactly what happened. As far as the coincidence, all you needed to look at is the commitments of traders on the dollar and on the bonds, and you knew it was too crowded. Large traders, hedge funds on the exact wrong side of the boat. So dollar will re-weaken, bond yields will start to come down, and those will be the two biggest surprises of 2025. S&P versus healthcare sector performance last 12 months. There's a lot of opportunities in healthcare. We're positioned through XBI. We're open-minded to pick up some more healthcare opportunities. And I think there's going to be a big catch-up trade in the healthcare sector. Moving along, we've got initial jobless claims went down. That's good. May affect odds of a cut in December, although it's been moving around. It got down to a coin flip. Before I delete this one, sentiment came down on the AAII sentiment survey. Bullishness came down to 30%, 37%. Bearishness went up, so that's good. There's not euphoria, so I think we can push higher. And there's just, like, who are the natural sellers in a year like this? There's not much tax loss. People don't want to pay the taxes until next year, so, like, expecting a big correction in December just because we're quote-unquote overvalued. Look at this. This must be from the Fed minutes. These odds dramatically changed. A week ago, you had 55% odds of a December cut. Now you're back up to 70% cut chance of a cut in December. So that's really good. If they get this cut in, I think they can be done for a while, at least till after March. They can just wait and see, which would be really good because it will cement the idea that they are not a politically based organization, that they did 2 cuts after the election, and then they can just wait and wait and wait. And maybe they'll only need 1 more in 2025 by front loading them. Very smart. And maximum maybe 2. But that's the perfect mid-cycle playbook like we saw in 1995. Another regional manufacturing ticking up. Japan inflation holds above BOJ target. Fenning December rate hike bets. We've been talking about this, ladies and gentlemen. Stronger yen, weaker dollar. Money flows out of Japan, back into China. This is the theme. This is happening in real time. Natural gas prices turning around like nobody's business. I mean, by the way, what about Comstock Resources? Like I say, we rarely spend time on the winners, but that thing's up from $9 to $15 in like the last 5 weeks. That's like a, 55, 50, 66 times. About 60% gain. And we don't even talk about it. But we love that. That's going to continue to work higher. Intrinsic values a lot higher, and a few bags from here. Widespread snowfall and icy conditions sweep across Europe with arrival of polar cold front. That's good. They need to buy their Goose, Canada Goose, now called Snow Goose. We're going to talk about that jacket. I ordered one. Awesome vest to go play paddle in the winter. And also you can wear it underneath a top coat when it's super cold. So I'm excited to get that in. Biggest outflow from healthcare since December 2023. It's one of the reasons I love healthcare right now. We also saw the exact same thing right after Trump got elected and what outperformed XBI afterwards. Dollar is expensive. We agree. Going to roll back over re-weaken, probably related to the hike that's coming from BOJ in December. Globalization to isolationism. This is the chart, ladies and gentlemen. This is what I was referring to with Stuart Varney. And this is absolutely amazing because not only are U.S. duties collected as a percentage of total imports near 130-year lows, but they are lower than they were under Clinton, under Carter for sure, under JFK, under all the favorite Democrats, had higher duties and tariffs collected as a percentage of total imports. And for those folks saying, if we do tariffs, the market's going to crash, just like holy smoot. Go read a history book. They put the tariffs on in 1930, and we got a Great Depression, and the stock market crashed 90%. Well, when you burden yourself with the facts, you can see that right after the Spanish flu, which is just like we just had COVID, tariffs increased from a many-decade low, which they bottomed at about 6%, and over the next 12 years prior to holy smoot, the percentage of duties collected on total imports grew from 5-6% to 20%, okay? 4x, 300% increase in tariffs for 12 years before Smoot-Hawley was announced in 1930 and you got your crash. So put it in perspective. Number one, we're starting from a much lower base. And for those of you who don't know, the 20s was one of the greatest booms in history, economically speaking. Growth, GDP, the whole thing, new industries, same thing we have. It was called the Roaring 20s. And we are going to have the roaring 2020s. So you have a 10-year runway. Even if Trump went crazy with tariffs, which he won't because he likes to see the stock market go up, we've got 10-year runway. And this could go from 3% to probably 15% before we had a massive problem. And people are like, well, how can that happen? Because you're going to see a lot of massive real and nominal GDP growth over the next 4 years plus. And so put this chart, print it out, put it on your wall, and for the next 2 years, every time you hear the word Smoot-Hawley, you can snicker and buy stocks. So 2 years in a row isn't a reason to be bearish. When the market's up 20% 2 years in a row, this is Ryan Dietrich at Carson showing the average return for the next year is 12.3%, median 12.8%. My favorite chart of all time. This is emerging market stocks relative to US stocks going back. And all I can say is, again, these are the opportunities where generational fortunes are made. When you can catch these lows, these divergences, like you haven't had since the Reagan era, second term of the Reagan era, second term of the Trump era, when emerging markets relative to US markets were as cheap as they are, and Bush 2 in 2001. Again, 2 Republican administrations, and then you also had Nixon before Carter, and you saw this come off the lows, emerging markets being the rock bottom cheap relative to the US. And the big analogy I like to use is 2001. We're lower than that level, and the fortunes that are going to be made by the people that take advantage of this. And look, we could be wrong, and it could take 2 more years to bottom out, but it doesn't matter when you're buying with that margin of safety and you're not on leverage. I'm going to bet we're there now, okay? And once it gets started, it's unreal. It is unreal. So there we are. Consumers are bullish on stocks. This was posted, this is from Renaissance Macro, as a reason to get cautious, except for the fact that when you see consumers get bullish on stocks after these great despondent levels like 2009, like 2011, like 1991 recession, that first spike is just the beginning of good things to come when you're coming off those lows. Same thing with 2003, beginning of good things to come. 2009, 2011, and so on. So this extreme is the beginning because you're coming off such lows. It overshoots on the low end, overshoots on the upper end. Big gains, after big gains, returns tend to be more moderate. Okay, well, we saw Ryan stuff. That's actually more empirical. This is also interesting. During the 2018 to 2019 trade war, margins came in below what volume growth implied. So what they're trying to say is because of the trade war, margins deteriorated, except for the fact that margins were still higher than they were under Clinton in the late 90s, and the stock market did well after the mid-cycle correction in 1995. So again, coincident versus causal are 2 different stories, and you have to be wary of getting faked out. And the secret to not getting faked out, in my experience, is zoom out. Okay, so don't just look, oh, well, if margins are going to contract, I better get out of stocks because of the trade war. If you go back, you can see when tariffs were higher under Clinton, the market had the biggest growth in the shortest amount of time from the mid-cycle correction in 95, and the Fed stepped in, did a few cuts, and we rallied even though margins were even lower than they were during the quote-unquote trade war. So were tariffs, by the way, under Clinton. Consumer confidence index turning back up. Global money market funds elevated. That money is going to come back in. Demographics are a tailwind to housing demand. Look how many 33-year-olds. This is why we've been pounding the table on roaring 2020s. Demographics drive spending. You buy a house, you buy a car, you buy a crib, you buy diapers, you buy stuff to show off in your 30s when you care about that stuff. By your 40s, you're already comfortable with what you've accomplished and who you are, and then you just do it for the love of the game. But that drives spending, and this is where we are, ladies and gentlemen. And by the way, China's similar. They're a little bit older, but they got 3 to 5 years. And by the way, for everyone who thinks I'm a China dove and I love China and all that stuff, nothing of the sort. Let me tell you something. I will be twice as pessimistic on China as I am on Japan right now, 5 years from now when their demographics change. I just deal with data. I don't care about ideology and narratives and feelings and all that stuff. I deal exclusively with data, and right now it's time to buy China and it's time to buy the US. And that's going to persist for at least 5 to 7 years plus. In the US, probably it could go as much as 10 years. In China, I think it's a 5-year window. We're going to see massive growth in a short amount of time. And then we're going to be out of China. And for those who think China is going to be the next great power, it's going to be the next great Japan after that last parabolic move. Go back and look at the Nikkei index and the demographics of the late 80s for Japan. Same exact story. They're toast. The one child left behind is going to hit them. It's not going to hit them in the next 5 years. They're still golden. It's going to hit them after that, and they'll never be able to recover. So don't worry about that. U.S. homes are getting smaller. I should do more of these podcasts on coffee. This is wild. This is a theme we've been talking about. Think Levittown. We're going to solve the housing thing under Trump. They're going to build so many small homes, it's going to knock your socks off. They're going to get the zoning thing so people can get rezoned. They can build the houses, get people in houses, raise families, rock and roll, absorb new positive immigration, which this country makes this country great. You've got to have massive immigration. You just want to have systems in place to make sure you're not letting in the wrong things. And if you look at Trump's tariff threats, all 3 of them were related to fentanyl. And I think if you know anything about Trump and you read The Art of the Deal or you watch a movie, I watched this movie called The Apprentice. It was a hit piece on Trump before the election. I didn't find it to be a hit piece. Actually, I learned a lot about it watching it, and I thought it was pretty useful. But, they showed how his brother died because he was an alcoholic. And I think this is an important issue for Trump in that he is so focused on keeping the fentanyl, and J.D. Vance, who grew up in a drug, I think his mother had drug problems, keeping that stuff out of this country, that Trump's announcement of China tariffs wasn't like, China, we're going to tariff you ideologically because we don't like you, like, other ideological groups had been doing. He's saying, you have not kept your word on the death penalty for people pushing fentanyl into our country through the Mexico and Canada borders. Therefore, we're going to increase another 10%. By the way, not 60%, another 10%, which is a lot less than advertised. He also said the same thing to Mexico, and he said the same thing to Canada. You're going to keep letting these drugs pour into the country and kill our people in the Midwest who are struggling, then the hardworking people, then you're toast, 25% tariff, 25% tariff. All of a sudden, the lady got on the phone, president of Mexico. She said, I'm sorry, we're gonna close it down. It's not that simple. It's not like a door. They can just lock the door, but it's moving them in the right direction. Trudeau, same story. They'll get it right. They'll come to some accommodation, but the free lunch is over. And I think that's going to be a great thing for the country in the near term. And look, for those of you who are not in accordance with that, benefit from the ride. Everything reverts to the mean. So it'll go back to the center in a couple of years, maximum 4 years, probably 2 years. But I think it's going to lay a framework for many, many years of growth ahead, and jobs and people that are not in the top 1% and not in the top 5% and not in the top 10%. The people that actually build stuff with their hands that have made this country at the amazing country that it is are going to start doing exceptionally well, like they did from 2017 to 2019 before the flu came in. And there's nothing like it. I mean, you can just feel the excitement in the air when you're out there. People are, in the stock market, we call it animal spirits. We're going to see some data on that. But just generally, people are happy. They feel good. And I think that's going to go a long way, that confidence ticking back up to really having a great, great run the next 4+ years, economically speaking, for a lot of people, not just a few people, for a lot of people. And I grew up carrying golf bags. I grew up washing dishes. I grew up with the newspaper route. I grew up with all that. So that is important to me because I know what it is to grind. I know what it is to have grit. I know what it is to, be in your early 20s and figure out how am I going to pay my electric bill. I know all of that stuff. And, a lot of people don't know that about me, and they think, oh, it just, it's funny. I get comments on Twitter and this and that, and people are saying, must have been hard to come from mommy and daddy's money. I wish, I don't wish, because if that had been the case, I don't think I would have had the joy and the fulfillment that comes from overcoming massive obstacles and scraping by, and the appreciation that comes with that. So, all right, we're off track. Up 20. Okay, we covered that from Carson. Summary of our forecast changes versus consensus. This is from Bank of America. So they're looking at GDP. They've taken their estimates up a little bit, higher for 2025, GDP up to 2.3. I think they're going to be low there. Unemployment rate, they've taken it down from 4.5 to 4.4. Inflation, they've taken it up. Okay, so they're kind of following that thing. But if you actually look at the first Trump administration, inflation actually trended lower. You get 3 million barrels excess of energy back on the market from increasing land leases and all that stuff. That is going to be a big deflationary factor. The second thing is, if they cut 50% of what they're talking about at Doge, and if you're betting against Vivek and Elon's ability to get stuff done, you're making a strong mistake. I think that, especially because it's going to come down to the Supreme Court, and I can't see 2 trillion, but these guys continue, especially Elon, has continued to surprise us. It always takes longer than he says it's going to take, but he eventually gets it done. So I don't know about 2 trillion. That would be deflationary, and Trump likes to see the stock market go up. But $1 trillion to $500 billion, I think, is in the bag, and that's deflationary. Bring inflation down, will be offset by some of the stimulatory practices, deregulation, etc. Home equity lines of credit have increased. The recreditization, if that's a word, of the American consumer is just beginning. You're going to see consumption come back in spades. That's going to help a lot of our consumer discretionary, et cetera, one of which we're going to talk about today. U.S. stock market concentration record high. That's going to be changing. 75-year high in U.S. stocks versus rest of the world. That's going to be changing. Doesn't mean U.S. stocks crash. Means that the rest of the world starts to outperform in a meaningful way. B of A forecasting 124 rate cuts by global central banks in 2025. That could be part of the reason why ex-US starts to outperform. And these are periods, as we've covered before, when you see these plus century marks of global Fed cuts, it's time to be buyers in the hole, not sellers. You don't want to be selling stocks in 2009 with 205 cuts. You don't want to be selling stocks in 2020 COVID lows when there's 162 global cuts. Same thing in 2024, 153 plus 154. This may be the most amount of cuts in the shortest period of time in history. You want to be a seller of this? No, you want to be a buyer, and you want to be a buyer of international to get the most value for your buck. Price is what you pay, value is what you're going to get. This major Chinese ETF set for record monthly outflows. They're selling in the hole, we're buying in the hole. We now have meaningfully more options on BABA than we did before the September spike, where we took off, I think it was like 80, 90%. We still have a few of those, by the way, at monstrous profits. So I've never been more excited, and I'm so grateful. If you remember when Tepper went on TV and said, buy everything, and I'm going over my position limits, blah, blah, blah. And he said, I'm praying that we get a massive pullback here so that I can go way over my position limits and buy way more than I've already bought. And BABA is his number one position, by the way. Now that we've got that pullback, okay, and this week everyone was under the table, round trip bullshit, okay, we were buying. And I'm sure Tepper was also buying in the hole. And you're going to see over the next 12 months what happens after the inauguration. We're very excited about that. I mean, I was so excited to see what happened in September, October, and so grateful for that. It just went parabolic. We had to hit the window on the options. We didn't sell a share of stock, by the way. So yeah, but I didn't think we'd get an opportunity to extend out and to get this type of exposure in the hole. It's super duper exciting. PCE prices going down, moving in the right direction, continuing jobless claims moving up. That is probably what got the, maybe I should switch to water, too much energy here. That is probably what got the Fed odds back up to 70%, which is huge. 4-week average coming down of the jobless claims. Services PMI continue to climb. That's massive expansion, just like you see off major lows. Consumer sentiment index turning up. Last month or so, turning up. Household consumption consensus forecast turning up since the election. Japan department store sales collapsing below the zero line. Everyone piled into Japan last year. They're getting taken out to the woodshed. That doesn't preclude buying cheap Japanese companies that do most of their business abroad. There are opportunities there, and smart people know where to find them. But chasing the crowd after the move is not the way to go. Net bullish, opened option strategies. So you're seeing this, but that's just at the nascent early stages of animal spirits. Biggest outflow in the past 2 weeks from treasuries. Again, exact wrong time. When did you see that? Late 2018, before the biggest rally in bonds. Top 5 offered payment methods in the global e-commerce market last year. Well, you had Visa, 90%. MasterCard, 89%. What was number 3, ladies and gentlemen? How about PayPal at 65%? By the way, unbelievable what's happening. People don't even realize, pounding the tables in the 50s and 60s. Everyone was like, oh man, this thing's been doing nothing for 6 months, blah, blah, blah. And then we'd go back down to 58 and we'd be like, ladies and gentlemen, cash flow going up, buying back 6 billion of shares, generating 6 billion of cash. Alex Chris, multi-bagger at Intuit. This guy knows what he's doing. Hang in there. Take rate going up. Let's rock and roll. Stocks up 30+%, 35%, and just beginning, ladies and gentlemen. So more offering than American Express. And people can't get enough American Express. You can't give away PayPal, but now they're coming along. They're going to chase all the way up. U.S. household balance sheets are in excellent shape. So everyone's saying, defaults and car loans and all this nonsense. Debt service as a percentage of disposable income is near all-time lows. This is the gas power composition. Natural gas is the name of the game. Love you, Comstock. All as other crimes slow, shoplifting soars. This has hurt retailers. 24% increase in shoplifting. This game is going to be over in the Trump administration. Yeah, it needs to be dealt with on a local level. But there was a message sent in the last 4 weeks that this stuff is no longer acceptable. The American people are demanding people take action. It is not okay to steal less than $1,000 of merchandise at a store and walk out unscathed. I'm not saying we need the fentanyl death penalty, but there needs to be some teeth. This is unacceptable. This is stealing from jobs. This is stealing from people's pockets. This is stealing from owners' pockets. And not a good thing. So this will get fixed. This will help consumer discretionary. This will help some of the retailers on their last legs and save a lot of jobs. Dallas Fed Manufacturing Index, another regional index, going up. Manufacturing recession is coming to a conclusion. It is going to be boom time for manufacturing and industrials. Animal spirits story count starting to accelerate, just like we saw at the beginning of the last Trump administration 1.0. You have not seen this many, quote, animal spirits references since the first Trump administration, which means risk is on, which means M&A, which means deals, which means refinancing, which means all good things, economically speaking. Ideologically, that's wrong podcast, ladies and gentlemen. I could care less about that. Economically, that's why you tuned in. Chinese exports are on track for another bumper year. So this is not, this is buried in the headlines. No one wants to talk about that. That will continue for another few years, in my view. La Nina cold weather could tighten natural gas markets, EIA says. We've seen it in the natural gas prices. Here's the Russell 2000 breaking out to all-time highs. Couldn't give it away last year. We kept pounding the table. Every single thing. Everyone says, shut up with your small caps already, blah, blah, blah. There were 2 guys talking small caps, 3 guys, Tom Hayes, Ryan Dietrich, and Tom Lee in big ways. Everyone gave Tom Lee a lot of you-know-what because they didn't go up 50% in 5 minutes, so it's taking a year and a half. Maybe 18 months, and now people are like, oh yeah, that makes sense. Mid caps versus large caps just starting to turn the corner. This is a proxy for small cap relative value as well, and that huge opportunity last time we saw was in 2020. It's happening all over again. Small cap U.S. S&P price index. Who is this? Deutsche Bank is saying it's going to get to 7,000 by the end of next year. I think that's a little optimistic. I think that takes 2 years or a year and a half at least. Then you've got S&P 500 sector groups earnings growth for next year forecast. So they're seeing huge earnings growth in materials. We've got Albemarle. We got to get more materials exposure if we can find some. Maybe some in the ag space. Those are so cyclical, but they might get interesting. You also saw Carl Icahn do that. Here's the 10-year rolling over as we had anticipated. It'll be fits and starts, but that's the direction of path. FOMC mentions of restrictive or related words and phrases collapsing, but they are still restrictive. They do have to come down probably a couple of cuts more to be in neutral territory, but they don't have to come down 6 more, that's for sure. 3 is a 3% terminal rate is not going to happen. Consumer Conference Board confidence just spiked up in the last month. Consumer expectations spiked up in the last few months. Consumer Board 1-year inflation expectations still going down. Advanced decline. This is the S&P 500, shows how breadth is improving. Mid caps breaking out, advanced decline. Small caps breaking out, advanced decline. CapEx growth going up. Options traders target higher U.S. Treasury yields. This is the perfect example of the crowd doing the exact wrong thing at the exact wrong time. So just as 10-year yield, Trump got elected, 10-year yield went up to 4.4 and change. What did they do? Like lemmings, they all went out and bought options on 465, 485, and these are all the macro funds. Just because they wear ties and have fancy credentials doesn't mean they're not lemmings and they don't crowd into the wrong things at the wrong time. And that's exactly what happened here. So what's going to happen? All of this premium is going to evaporate, and the schmucks who bought it are going to be left with goose egg, and the geniuses who sold it are going to mint money, and that's the way the game works. Rolling 4-year average flows positive the last 2 weeks. This is net buys of U.S. equities. They've been selling all year long while the indices have gone up, and now they're playing the catch-up trade into year-end. Average stock trades as a wide discount to the index. This is where the fortunes are going to be made, ladies and gentlemen, in the next year. In the average stock valuation relative to the S&P is so inexpensive, and we haven't seen this since 2001, which has been a template for what we're talking about in coming years. Top 7 S&P companies account for 30% of the benchmark. That is going to change. Peak growth priced in for the Magnificent 7. You haven't seen this level of extreme since late 2021, before the Mag 7 dramatically underperformed in 2022, and a lot of people got smoked chasing at the end of 2021 when they didn't want to buy in 2020. I'm not saying Mag 7 is going to crash. I am saying they are going to underperform over the next 2 years. No, and they have been for the last 6 months, by the way. Water now, my favorite mug for my buddies in Dallas. Hedge fund tips. And that was when we were at episode 200. Now we're at 267. November Global Fund Manager Survey. Long Magnificent 7 is still the most crowded trade. Globalization contributed to margin expansion in the 2000s. 1980s to early 2000s, labor efficiency gains. We've just broken out. This is what you saw starting in the Reagan administration all the way through the Clinton administration, where the revenue per worker just absolutely accelerated. We've been consolidating sideways for over a decade and a half, and we just broke out. Labor efficiency is growing. That is the magic ingredient, productivity and efficiency gains for long-term bull markets, of which we are in smack dab in the middle of, and will probably end in the early 2030s. Bullishness is extreme, but not excessive. We're nowhere near where we were in the early 2000s. This is the PE, which is skewed by Mag 7. So the opportunities under the hood. Valuation currently suggests 0 to 1% per annum price returns over the next decade. I love this. This is so beautiful, ladies and gentlemen, because they're basically saying all the gains for the next decade are gone. You're going to get no gains from S&P. And you see this lost decade bullshit every few years. I'm not even going to point out, but just Google lost decade, and you'll see all the people from the lows in 2009 who have been saying it for the last 15 years. And they used to manage trillions of dollars of money, and these guys were just getting it wrong for a decade. And we haven't been this low in terms of expectations. The secret to happiness is low expectations. Since when? Since 2001. And you had the biggest growth in the shortest amount of time in emerging market stocks when expectations for US stocks were at 0 for the next 10 years. And that's exactly where we are now. And people are using this as a reason to say, get out of stocks at the exact wrong time. And you wanted to be getting into stocks in 2001, not only US to a lesser extent, but to a larger extent, ex-US emerging markets. Lower financial leverage than the 1990s and 2000s, so healthy balance sheets, higher quality composition than prior decades, more asset light, so it warrants higher multiples is the point they're making. Economic data surprises have turned more positive. We covered the margin issue. M&A tracking above 2022 and 2023 levels. That's going to persist. The question is how much of it's priced into the big banks, which is why we took profits on Citi over the summer, which basically has done nothing since. So if we get some type of pullback scare, which usually you do in February, people start taking gains and raising cash for taxes and all that stuff. So February, you usually get weakness in the market. Maybe we'll have an opportunity to re-enter some of the bigger banks then. Typically, IPOs outperform in both the short, medium, and long term. So you see the first few months they do well, so there's an opportunity to look at IPOs that are 3 years old and left for dead. There were a ton of them in 2021, and now a bunch of them are getting cheap enough that it is getting very interesting. So that's going to be an area of focus. Next, old economy sectors stand to benefit most from regulatory laxity. Materials, industrial, consumer discretionary, we're positioned for all of those. Growth from materials, tech, and healthcare. This is earnings growth for next year. So materials, again, we got to pay attention to healthcare, biotech, industrials, consumer services, etc. Opportunities there. Goods and services consumption remain depressed, but is likely bottoming. This is going to be great for the likes of the Gooses of the world, the VF Corps of the world, etc. Including the Mag 7, consensus expects just 2.5% volume growth in 2025 against easy comp of just plus 5.5% in 2024. So there was basically a retail and consumer, mini recession in 2024 that probably troughed in this most quarter that's just been reported, and will reaccelerate in Q4. I think we're going to have a solid holiday season. And a lot of those retailers and consumer discretionary names are going to do better than people expected after a soft Q3 with the weakness into the election anticipating. And you can see the expected growth moving forward, consumer services, healthcare, real estate, utilities, etc. Volume growth since hiking cycle has been negative, but demand recovery equals margin expansion. We're seeing that. Materials, industrials, and tech are expected to drive the biggest margin expansion in 2025. Same story. The worst of the inventory destocking cycle is likely behind us. Again, for those of you who think you missed it, it's just starting. We're kind of at the 2010 level and the 2002 level, and you had many more years of rally runway. And if you think about it in terms of cars, it's early days of the recovery of volumes. Semis and autos saw the biggest decline, days sales of inventory year on year by S&P across sectors. This is going to reverse. Easing rate pressure should translate into pickup in manufacturing. We agree. Mag 7 earnings are expected to slow while other 493 are expected to accelerate. We've been saying this is coming for the last 6 months. It has come. It is going to accelerate through 2025. Indicator suggests 14% year-on-year EPS growth in Q4 versus 9% consensus. That's a big deal. We did 5.8% relative to 4.2% in Q3. We're going to jump in Q4 to 14%. So selling stocks before the end of the year when no one has a reason to because they don't want to book the taxes and anticipating great earnings results for Q4, you don't want to be a seller probably through late January or February. If you want to take profits, take them then. Corporate misery, by the way, all this is opinion, not advice. Go to hedgefundtips.com, click on terms, talk to your financial advisor, etc. Corporate misery index remains weak. Weak just like 2001 before the biggest move in the shortest amount of time. Weak just like 2009. Weak just like 1991. Weak just like 1982. You want to buy when the corporate misery indicator remains weak. You don't want to buy when it's at the peak necessarily. So labor productivity, we covered that breakout. Domestic investment is picking up after 10 years of underinvestment. Mentions of reshoring increased sharply, off the charts. Construction spend on manufacturing soared in recent years. Interest rates coming off 5,000-year lows. Yeah, not 5-year, 5,000-year lows. Rate cycles can last for 4 years. So people are trying to extrapolate this is going to go up and up and up. It's not going to go up and up and up because population in the developed world is flatlining. This is going to remain subdued. You get these spike ups like in 1895, back when I was only 3 years old. I'm just joking. And then it spikes back down. But in the 1800s, you saw tons of these. There was one example here in 1930 to 1968 where it went straight up. I don't think you're going to see a repeat of that because we have got too much debt. We first need to bring the debt to GDP down, which we will. We'll grow our way out of it, which Besant's 3x3 plan. Let me see if I can remember this. Bring the budget deficit down to 3%. Budget deficit, 3 million more barrels of oil. And they're going to bring the budget deficit down through the Doge cuts and through other factors. And they want to run real GDP hot, which has been the playbook that I've been talking about post-World War II. Why I love Besant because he's a student of history like I am, like we are. He understands the post-World War II playbook, which I said they're going to run this playbook. I thought Powell would figure it out. Besant's going to be the guy to do it, just like Mnuchin knew the playbook. And they're going to run inflation and they're going to run nominal growth through the roof the next few years. And that debt to GDP is going to start to collapse from 122 down to below 100 and then beyond, like from 1948 to 1956 when it went from 120 down to 63. Inflation ran 3 to 5%. Nominal growth was high single digits. And we're going to see that type of environment. And Besant knows the playbook. So that's his 3x3 plan. Perfect pick. Kudos to the administration for getting that right. More than 1 in 3 Russell companies is unprofitable. They say that like it's a bad thing. When's the last time you saw that? Was in 2010. You wanted to be a buyer of small caps. You saw it in 2001 when you had the biggest rally in the shortest amount of time in small caps history. And they're saying that like it's a bad thing, it's a great thing. That's what you see at the beginning of every small cap cycle. Number of U.S. stocks shrinking since the late 1990s, so there's no supply. Don't worry, Wall Street, when the ducks are quacking, Wall Street feeds them. You'll see a ton of IPOs in the next 2 years. Forecasts predict an 11% CAGR for electrical demand among data centers. Nuclear is going to take 10 years to get online. Where's all that power going to come from? It's not going to come from solar panels, ladies and gentlemen. It's going to come from natural gas, Comstock Resources. Corporate CapEx is consistent multiple of fiscal spend and is slated to grow, not shrink. Valuations and positioning for value over growth. Again, once in a generation opportunity, haven't seen since 2001. Deep discount on PE to growth. That's the PEG ratio. Haven't seen since 2001 this low. Price to book, haven't seen in decades. Price to sales, haven't been this low since 2001. These are just, you get these opportunities once or twice in a career, and everyone's at the wheel, sleeping and trying to chase the Momo stocks that they're going to get their faces ripped off and lose 80% of their money. Accelerating profits growth would historically favor value. We expect earnings to accelerate in 2025. Small cap earnings guidance now above average on a 3-month basis. Same with mid cap. Small caps remain relatively cheap to large caps, back to 2001 again. Mid cap, same story. Materials trade below its historical premium. Again, that materials narrative. Free cash flow yield is, yes, less compelling than it once was. It's higher. It's still higher. It's still a better opportunity than it's been in 25 years. Communication services relative to forward PE versus the S&P 500. Again, not a better opportunity since 2009, and then back to 2001. So there's opportunity to find in there. Mag 7 earnings expected to slow. Other 493 accelerate. That's been happening. And then macro cycle set to shift from recovery in 2024 to boom in 2025. That's from HeartNet, one of the best in the business. All this cash and money market, 6.2 trillion, has to put to work. And they talk about bubbles over the last 50 years, gold in the 70s, Japan in the 90s, Asia, internet in the late 2000s, housing in the late 1990s for internet, housing in the early 2000s, China in the mid 2000s, biotech in 2014, Bitcoin came down, ARK was a big bubble in 21, FANG, and Magnificent Seven. So there you go, ladies and gentlemen. That's a lot of data for a holiday week. Fed odds we got. Emerging markets we got. November 2024, U.S. auto sales showing signs of progress, thanks to my buddy who sent that over. Basically what they're saying is November is up to 1.31 units, a growth of 6% from the year ago level. That's with record high interest rates. Wait till rates continue to come down. Credit is starting to flow, and that translates into a 15.9 million SAR in November, on trend with the 16 million unit mark realized in October. So remember, everyone was pessimistic after September. It bounced right back. Never order this pricey cut of meat at a steakhouse, New York chefs say. Here's the one to try instead. So they're saying avoid the filet mignon. They've got to put, I'm a steak guy. They have to put all these sauces on to make it taste good. Get the bone-in ribeye, ladies and gentlemen. I learned that not from this article, from many years of eating steak. But I also want to thank my buddies Isaac and Jacob. They've been longtime listeners and friends, etc. We went out to steak dinner together, and this was a few years ago now. And they're like, you got to get the bone-in ribeye. I was like, the ribeye, really? That's not like a lower cut. I would always get the porterhouse on the bone and the whole thing. It's so much more tasty. So for those of you who have been eating too many vegetables, order yourself a bone-in ribeye and live the dream. Fed Williams sees inflation cooling and interest rates falling further. We like the story on that. That's confirmed by the December odds. Billionaire investor Howard Marks is snapping up, quote, uninvestable Chinese assets. Legend in the business. No one wants it. He's going in and doing it. How I learned to stop worrying about the national debt, even though it's 35 trillion. This is an article in the New York Post by Ken Fisher, and he goes through all the data and inflation adjustments, etc. It's worth reading. I'm not comfortable with it because I'm comfortable with it not for the reasons that he lays out, but he does lay out good reasons in terms of the servicing and how they're going to deal with that. I'm excited because Besant's going to run the post-World War II playbook and bring the ratio down. Bond market halts brutal run as buyers pounce on 4.5% yields. U.S. Treasuries rally on bets that Besant will soften Trump's plans. That and half the world is offsides on the bond trade. This is super important. The AI race is entering a new stage. NVIDIA won't be the only winner this time. Okay, now, why is that important, ladies and gentlemen? Okay. At some point, AI's emphasis will shift from training, that's the large language models that take up all that compute power, all that energy, all the data centers, to inference, the process of generating answers from results from the models. So the models will be built. That's the capital intensive phase. Many in the industry now believe that dedicating more computing power to inference can provide similar benefits to training. It's cheaper, less energy, different type of chips. What we are seeing the emergence of a new scaling law with inference time compute, Nadella said at Microsoft's Ignite conference. The inference focus has big implications for NVIDIA. While training is uniquely suited for the company's GPUs, inference might be more readily handled by AI processors from NVIDIA peers like Advanced Micro Devices and Intel. Intel, ladies and gentlemen, Intel. By custom chips from Amazon or by a range of chip startups. This is huge because you're going to start to hear more and more from these hyperscalers talking about inference versus training the models. Training the models, NVIDIA wins. Inference, Intel wins. And this game is just beginning, and it's going to be part driven by cost, part driven by energy, part driven by efficiency, part driven by demands from shareholders for returns on investments from the hyperscalers. And we're going to move into the inference phase now that a lot of the model training is, the majority is done. There'll be more model training, of course, but the inference is where they're going to get the value for their investments, and Intel is going to be there to service that demand that is just getting started. By the way, they got their $8 billion from the government, which is awesome. Stimulus rumors as insurance companies told to buy stocks. This is China. This is from my friend Brendan Ahern over at KWeb. And what he's saying is the chatter is that the China Economic Work Council, which usually takes place in mid-December, will occur in early December, with further speculation that the fiscal deficit will be expanded from the 2024's 3% to 4.5%. Hopefully the rumors are true. One factor that likely contributed significantly was a release from Li Yunzi of the State Administration for Financial Regulation, stating that the insurance industry should, quote, increase investment in areas such as strategic emerging industries, advanced manufacturing, and new infrastructure. As an FYI, you will only read about this here. This would explain why the mainland's pure technology play, the Starboard, gained 3.61% versus the partial technology Shenzhen's gain of 2.07% and the technology light Shanghai's gain of 1.53%. Insurance companies putting money to work would help stem the stock market's recent slide after ripping post-stimulus announcement. Remember, El Jefe said the stock market is higher through mainland margin balances have fallen significantly. Insurance companies are being told to buy stock. To buy the stock market would help. Interestingly, the national team's favored ETF had below average volumes again. So this is from Brendan Ahern giving us the inside scoop, which is why we read him every day, and great work there. Hyder Ackerman releases his first Snow Goose by Canada Goose capsule collection. Right here is Ethan Hawke in the Ryder parka. These are cool because I like the fact that the Canada Goose thing is the same color as the jacket, so it's more like hidden, and they're going with the original. For those of you who don't know, Canada Goose has been around since 1957. It was hot before Drake was hot, and it'll be hot after Drake is forgotten. And for the U.S. money managers that don't realize that the big game is in Asia on the Canada Goose, and it will come back to the U.S. with cool stuff like this. So This was launched the 26th. They're going to do. They held back on advertising the first two fiscal quarters of the year, 2025 year. They don't operate on a calendar quarter. And so they're going to push this into the holiday season. I think it's going to be a huge home run, right thing at the right time, pick up the advertising spend, and they're going to have a monster quarter. So we'll talk about that in a little bit. Trump says Mexico president has agreed to stop migrants crossing into the U.S. through her country. Very productive conversation. We'll see how that plays out, which means probably less tariffs than advertised. China needs $1.4 trillion to boost domestic consumption amid impending trade war 2.0. So I think this is going to be a positive thing. It's going to get maybe at this meeting that Brendan's talking about, maybe it'll get them to do. They did the $1.4 trillion in an indirect way. They need to do it in a consumer way, and maybe we'll see some of that in coming weeks. Last Trump point one, it took till after January 1st before the inauguration for China to start to take off. Maybe this time will be a little different rhyming, but maybe a little bit early. We'll see. Intel received $7.9 billion in CHIPS Act funding. They finally got that. That is huge. Turkey or Goose, stock market and sentiment results. Here's my buddy and client Damien on his snowmobile, and I decided to put this as the article of the week photo because he was wearing his Canada Goose parka here, and he said he was in 20-degree weather in Utah. He's built a great, unbelievable real estate business in California. He was in Utah, 20-degree weather, going 20, 30 miles an hour on his snowmobile. He said he was warm as warm could be, best jacket in the business. Okay, so we covered that. Here we go. I'll be a little informal today since it's a holiday and all, so here it goes. While there's a sizable contingent of family offices, ultra-high net worth business people, and investment professionals that listen to my podcast every week, there's also a very large group of young listeners who have helped push my podcast to the top of the charts in the hedge fund category. In my weekly podcast VideoCast, not only do we talk about companies and economic data, but I try to share some career and life lessons I've learned along the way to be helpful to. So the one thing I've learned is that you're going to come across two types of people in the path towards your goals. The first is the phony type who are waiting to see you make mistakes or slip up and will be quick to point them out. And the second type of friends who are going to try to help you and are rooting for you every single step of the way. I've aimed to not only be part of the latter group, be that type of friend, but recognize and befriend those who display similar characteristics. Part of the secret to success, quote unquote, is to avoid or disassociate from the former and to befriend and nurture relationships with the latter. The old cliche is 100% true. Quote, you become who you hang around. I'm blessed to have great family, friends, and business partners in my life. And on this day, Thanksgiving, my favorite holiday of the year, I wanted to acknowledge one friend who embodies what I'm describing above. So yesterday, I quote unquote caught my buddy Lou Bassanese on Cavuto Coast to Coast on Fox Business yesterday, giving me a shout out on Disney. And I wanted to point this out because it's very rare for someone to point out the ones that work. People are quick to point out the ones that take longer and give us a tough time. But Lou's a different kind of guy, and everyone knows it. A+ in my book. It really doesn't get any better than Lou. So I'm going to play the short clip here.
How badly does Disney need Moana 2 to be a hit like Deadpool and Wolverine?
Look, I got to be intellectually honest. In August of 23, I called Disney a dumpster fire for capital, and I wasn't wrong. It really was when Bob Iger came on. But after suffering $11 billion of losses, they've turned around the streaming. They're starting to make profits, strong growth. They've had big hits. Moana 2, this could add significantly to their profitability. I think they absolutely need the momentum to continue in this business. The thing that's always kept me away from Disney is that it's so consumer-based and driven, and right now at a time when the consumer is very strapped. But that being said, if you look, this stock has definitely bottomed out. I got to give credit to my friend and Wall Street colleague, Tom Hayes from Great Hill Capital. He's picked this bottom early and been right. I think there's much more room that Disney can go under Bob Iger, and I think there is a window, right? He is going to step down in 2026.
And we're back. Lou is president and chief market strategist at MDB Capital, so you can click there and see all about him and what they do over at MDB. Very interesting story, and a lot of you could probably benefit from what he does as well. Goose Cooked or Goose Loose. The featured picture is another friend and client, Damien from Los Angeles, who built an amazing real estate business in California. He posted a picture, and I thought it was the perfect header for this week's note, given the fact that he happened to have a Canada Goose jacket on. Unlike Lou, who likes to highlight my winners, for those of you who have been around the podcast VideoCast for some time, you know I spend 80% or more time on the holdings that have yet to take off and less than 20% of the time on the ones that are and were home runs. Canada Goose falls into the former category. Our basis across all accounts is a little over $11 a share. This was a growth story that turned into a value story when we initiated and has a chance to turn back into a growth story if they execute on their plan and catch a little tailwind in the Asia recovery, as well as cyclicality. They've been through these cycles many times since they started in 1957. So while it is still a small position for us, I'm looking for windows that will make sense to upsize it into a full-size holding as the data confirms the original outlook and thesis. We've been modestly topping up on weakness, but have yet to lean in with the cannon so far. We may never do it, but I think we'll be paying close attention to opportunities as the data comes in. So, 10 key points from Canada Goose November 7th earnings results and call. First off, revenue, $192 million, beat expectations by 7.86 despite a 4.9% year-over-year decline. EPS estimate beat estimates. A company expanded its permanent store count to 72 locations. If you remember from the long-term plan was to grow the DTC and reduce the wholesale. Inventory levels decreased by 9%. Net debt was decreased by about $25 million. Spring and summer collection was well received, indicating potential for a robust annual lineup, not just the heavy down lines. E-commerce traffic increase, suggesting growing online interest in the brand. Companies broadening its product range with plans to launch an eyewear line. Positive trends have been observed in the Chinese market, particularly during events like Golden Week and Singles Day. The company is focusing on expanding the non-heavyweight down categories and diversifying into non-seasonal apparel, which could lead to year-round revenue opportunities. The cornerstone, in other words, the business is very cyclical. I'm going to show you the data, and you'll see. Cornerstones of the turnaround plan are twofold. Reduce the wholesale, and two, make up the difference with broader product offering and more DTC stores and high-margin opportunities. The expected long-term benefits of the DTC plan for Canada Goose include higher profit margins by eliminating intermediaries. Canada Goose can capture a larger sale of the whole retail price, leading to improved profitability over time. Enhanced brand control. The DTC model allows Canada Goose to take greater control of its brand narrative and product distribution. Improved consumer engagement. By the way, it's interesting. You're seeing this because I ordered that Canada Goose vest yesterday. You couldn't really find any Black Friday deals, and all the Black Friday started a week ago because it's a shorter holiday season. So they have controlled their price. There were no real discounts online, and I like that because their margins are going to continue to stay high. Reduced wholesale presence allows for less dependency on markdowns often seen in wholesale partnerships. Better inventory management. The shift to DTC enables more efficient inventory control, as evidenced by the 9% decrease in inventory levels. Valuable consumer insights. Direct interaction with customers provides data that can inform product development and marketing strategies. Increased operational efficiency as Canada Goose optimizes DTC operations. It may benefit from economies of scale in retail and e-commerce channels. Global expansion opportunities. The DTC model facilitates easier entry into new markets, particularly through e-commerce. Enhanced customer lifetime value. A strong DTC presence can potentially increase brand loyalty and customer retention. Agility in product offering. Direct sales allow for quicker adaptation to market trends and consumer preferences. At the end of the day, that's just a bunch of words. The numbers tell the whole story, which is why on golf cards they make the box so small so you can't fit in the story, just the number. Price is what you pay, value is what you get. While free cash flow has materially recovered, price has remained subdued. I built my career on capturing divergences like this. And you can see free cash flow trailing 12 months, accelerating. When that happens historically, what happens? The price follows. Recovery in cash flow, price follows. Recovery in cash flow, price not following yet and will follow. Revenues continue to climb. Return on invested capital is still high single digits, despite that we are in a trough recovery cycle. Destocking turning into restocking as the inventory management under control with reducing wholesalers. Gross margins still at 68%, which is an unbelievable business. And then I want to get into more granular numbers. And as I say on this article, this is the Farrah Fawcett of financial pictures in my view. And if you're under 40 years old and don't get the reference, just Google Farrah Fawcett. And here's a lovely picture of Farrah Fawcett from Charlie's Angels. And as lovely as that picture is, the value line financials for the last decade are even more lovely than that beautiful smile, in that the sales per share continue to go up, the cash flow per share continues to go up, the earnings per share continue to go up, the sales continue to go up, the operating margin. The only thing that has gone down is the price, and we believe that that will start to play catch up. Look, it's not all peaches and cream. Revenues were down 4% year on year, but this is a cyclical enough business that you have to accept and trust that they will figure it out, as they've done since 1957. Anytime you find yourself in a situation where the financials continue to recover and improve and the price continues to decline, count your lucky blessings. Mr. Market is serving up one of his manic bouts to deliver you an opportunity to benefit from a rare divergence and dislocation. If you don't understand the manic nature of Mr. Market, read The Intelligent Investor by Benjamin Graham, Warren Buffett's favorite book, changed my life. In the case of Canada Goose, North American money managers think it's over because Drake lost his Canada Goose jacket. While they miss the fact that sales are doubling in certain parts of Asia and the amount of cash the business generates per share has never been higher or cheaper to purchase an interest in. Price is what you pay, value is what you get. As we know, Goose generates the lion's share of its revenue and profits in the fourth calendar quarter of the year due to the holidays. They also have held back on normal marketing spend this year to focus on this quarter's launch of the first seasonal capsule collection from new creative director Hyder Ackerman, designed under the brand's heritage label, Snow Goose. And there's Ethan Hawke. And here is the cyclicality of the business. This is going to change now that they're getting into lightwear. It's not going to be so dependent on the fourth quarter, cold winter and holiday season. But you can see, going back to 2016, the story is the same every year. They basically do nothing up until the third quarter, calendar quarter. They start to ramp, and the fourth quarter they shoot the lights out. Fourth quarter they shoot the lights out. That's when they generate all the free cash flow, and the same will be true this year. As we see the spike up, cash comes in, everyone's happy, and maybe accelerated by the ad spend and the big push of something new. First time you're having something big new in the heavy down in a while, and I think they're going to push this hard, and I think it's going to be well received. Hyder Ackerman releases his first Snow Goose by Canada capsule collection. We are going to know a lot more in 60 days if this was the hit they needed to reignite their heavyweight down part of the business. I wouldn't bet against a 67-year-old brand of this caliber trading at these levels. Canada Goose was big before Drake and will be big again before Drake is long forgotten. In the meantime, free cash flow is recovering nicely. General market fear and greed's at 64, getting elevated but not yet extreme. National Association of Active Investment Managers pretty flatlined at 90%. Up there, again, not at extreme, probably more room to run into end of year. S&P earnings, basically revisions last 60 days, flatline, down 27 basis points. Russell, same story, 55 basis points. Economic data, we've covered most of this. Earnings now starting to reaccelerate, estimates back up to 275 for next year. And we're done with the podcast. Now we're going to do the Ask Me Anything questions. So for those of you who love the Ask Me Anything, stick around. For those of you who don't, we'll see you next week. Have a happy Thanksgiving. Enjoy the football fun and family. And here we go. Lachlan Neo. Tom, this is more of a career question. Is the CFA useful to break into finance? How does one get into value investing career like yourself? Yeah, I think if you don't have any experience, that's table stakes. So go get your CFA. And if you're doing it to get a job, save yourself time. If you're doing it because you love it and you want to learn as much as possible as an investment in your future, I would highly recommend that. Next, Eric. First of all, thanks for the amazing content you're putting out. I can't find another podcast that even comes close. As for the question of the week, this is from Sampy Kamas. Okay. I know these are too large for you, but Google and LVMH seem to me to be undervalued here. Valuations look good to me. Good cash flowing businesses with good financial health that can perform great. Would love to hear your thoughts. In any case, thanks so much for all the content you're putting out. All right, Sampy, thank you for writing in. You're probably newer, so you don't know our Google history, but we were massive buyers of Google in the hole in late 2022 and early 2023 when no one wanted it in the 80s and 90s, and we took profits this summer with more than a double bag in that, and now that it's up here, everyone's getting interested. I'm not going to argue with you on that, but we have to book wins, and we were happy to book it, and we have no urgency to get back in, especially when we're using ChatGPT and Perplexity and Meta AI a lot more than we have been in recent years. So I think Google will be fine. I think the opportunity to buy it was when no one wanted it, not when everyone wanted it. As it relates to LVMH, I think you're spot on, but we have enough consumer exposure and China exposure, which this is basically just a play on the China recovery, which we have through Goose and Baba. So let's just take a look at here. The financials. All right, so cash flow dropped. It's recovering. Revenues, gross margins, same as Goose, 68%. Return on invested capital. So the stock's down about 40%. I mean, this is such a super high quality business that I think you're going to be super right. But I think you might be a little bit early. So yeah, I think you're probably okay with this. I mean, I think there are higher, better uses for us, but I don't think you're wrong here. I just think you got to wait a little longer than you think. I like that one better than Google, to be honest with you, but not enough to get involved. All right, that's that. Julian Glock. I see an increasing amount of people I follow expecting not only a pullback, but rather a crash in Q1 or Q2 of 2025 as markets seem stretched, melting up to them. Now, I was, of course, wondering about your take on this and if it should come to that, whether you would hold long-term positions through such times, or are there moments when you would go entirely to cash? Okay, good question. Number one is the people calling for crashes are the ones that missed the rally. Number two, I do expect a pullback in the first quarter, probably 8 to 10%, probably around February, completely guessing. And because of that, no, we would not sell any of our long-term positions unless they were at or fully invalued, irrespective of our guess about when the next correction is going to come. I don't believe it'll be a crash. I don't believe it'll be 20%. I do think we're due for an 8 to 10% pullback. And I don't think it's going to come until at least late January, early February at the earliest, or late January, February at the earliest. And the way that we will potentially participate in that is we'll use part of our options bucket to hedge or find tactical shorts in the short term. And the only benefit of that is just dampening volatility and creating some excess cash to go long. No, we don't guess about when the market's going to pull back and try to be nimble and silly about that, because going back to Peter Lynch's, more money has been lost preparing for corrections than the actual corrections themselves. Number two, we don't run high leverage, so we just deal through the volatility. It's like, would you sell your Jersey Mike's if you own 20 Jersey Mike's stores, and some economists said there was going to be a 20% pullback in the stock market, therefore people are going to have less money to buy sandwiches or less consumer confidence, so for the next 6 months sales are going to be down, sell all your franchises in the hole at low price? No, you would say, if you're smart and you want to get rich, you would say, oh, I wonder if any of my competitors are going to sell at lower multiples in the next 6 months when sales go down, so I can have 40 stores instead of 10 stores and buy up those opportunities, because when it comes back, I'll make even more money. That's the way to think about it, not going to cash and all this nonsense and pretending to predict the market. So hope that helps. And good question. Adgard, after the latest meltdown, do you think Target can be a good entry opportunity? Do you think an activist investor might be imminent there? Thanks for the amazing content. Well, I think number one is they got to start catching criminals who are stealing all their merchandise, because somehow Walmart has not had the same problem. Number two, stop offering ridiculous products to children, but we'll leave that aside. I don't think that's the core. I wouldn't count against it, but let's just focus on the numbers here. So you're seeing a slowdown, and you're seeing it reflected in the stock price, both in free cash flow, revenues stalling. I think they've become a Me Too retailer. Their gross margins haven't recovered yet. They don't have anything exciting or fresh, is really what it comes down to. I think they've gotten sidetracked, and I don't think that this is one I want to rush into just yet. And I think retailers, if you remember from our last few podcasts, did poorly after the inauguration in Trump 1. I think there will be a time to get involved. I just think it's nowhere near ready yet. Send it back in. If it gets below 100, I'll take another look. Moving on. Peter Webster, here's one for your emerging markets. Banco Colombia is a well-run bank paying 10.4% dividends like Argentina. There is an uplift if there's a change in government. CIB, I'm told, is the best bank in Colombia. Pete. Okay, Pete. Well, thanks for that. I don't think there's a question there. I don't bet on potential changes in government, and I don't tend to trust double-digit dividends staying intact. It may prove to be correct, but just taking a brief look, this has already had a big run off the bottom. It's a little late for my liking. Greg Altamari, thanks for your input on Oxy. Please take a look at Diageo. We own Diageo. We like it. It's going to be a bit of a trek turnaround. This is a new position for us. We're not writing about it yet. Again, this has China exposure. This is going to benefit from emerging markets. It did the exact same thing in 2001. So this is the best quality business. Yeah, GLP-1s will have an impact, but really this is a turnaround China recovery play. And just looking at the numbers, you can see that the stock price has overshot the deterioration in the financials. They had a lot of pull forward during COVID. in terms of demand, and now they're working through that, and they had some issues in South America. So prices come down with free cash flow. Revenues have been flat. They need to reaccelerate. Margins are holding up. Return on invested capital is solid, continues to be double digits. So this is just a waiting game. It's the best game in town. If you want to bet people will never drink again, then you should get short the stock in the hole. If you want to say people continue to like to escape. I always tell the one thing I like about what Trump did with his kids is no drinking, no drugs, no alcohol, no tattoos. There's nothing wrong with any of those things in moderation, I guess. But the fact of the matter is, since the beginning of time, people have wanted to escape from reality, and alcohol is one way they do it. And GLP-1s or not GLP-1s, I think they're still going to want to do it, and I think Diageo is going to provide for that service. So is it the investment that I'm the most proud of in my life? No. But again, I don't deal in ideology. I deal in numbers. And the fact is, there's a demand in the marketplace for this. There's going to be a continued demand. There's a growing new middle class in emerging market that is growing like a weed that is going to get involved in this space. And they're going to have celebrations, and they're going to have social gatherings, and they're going to have, even if they're drinking less, there are going to be more people drinking, and Diageo is positioned to benefit from that. So let people be happy the way they want to be happy, and we'll be happy taking it all the way to the bank. So we like Diageo, and good one there, and we own it. Nuvdeep Basin, thanks for everything. You and your podcast have been a blessing. For your restaurant play, could the ticket Yelp qualify tech play to cover overall eat out dollars rising over the next 4 years? Kind of off the wall, but love to hear your thoughts. You thankfully butchered my last Beyond Meat suggestion. Exactly. There we go. All right. Thanks, Nate. Happy to do this one. Let's do Yelp. This is a trading vehicle. This has been a crap business that continues to trade in a range. Let's see if anything has changed in the numbers that can change our mind. All right, cash flow is going up, or had gone up, price gone up, revenues went up, return on capital, margins are down. This is a tricky one, my friend. I'd have to understand what the turnaround plan is and why it's sustainable. Why are the numbers modestly improving? Did they buy something? Did they consolidate the industry? How's the balance sheet? Balance sheet's great. Yeah, the good news is you're probably right. The bad news is it's probably only going to be a cyclical short-term trade back up to 50. But I hope I'm wrong about that. I think you got a good trade. I don't think you have a good long-term business. Let's move to Jimbo. All right, so he's saying, I like your buy of Etsy at $48. What's your target price? We're not going to publish that. That's for our current, because then people are going to try to front run our exit. But I can tell you this, that we don't get involved in any stock that we don't anticipate a double inside of 3 years. Some of them have much more than a double. And then when you add our options overlays, they all have more than that. So I would say no less than a double in 3 years. And on most of them, a lot more. And then certainly a lot more when you add in the option overlay. So we'll leave it at that. Matt Tumbo says, I've been in MMYT. Yeah, so that's something you've been in. Congratulations on a good trade. A-Rock short. Okay, so he just wants a pat on the back. Great trades, Matt. Awesome. Glad you're listening. Glad to be helpful. David McLean. He's asking about Alibaba's B2B. Isn't it incredible? Yes, it's all incredible. That's not going to be the primary mover. It's going to be a contributor as the economy recovers. Alibaba is the toll gate for the China recovery. So if you believe, like every cycle, they recover, dollar gets weaker, emerging markets fly, and all the case that we've made around that, that's just going to be one of the factors that absolutely flies for Alibaba. The only thing this time that's going to make it better than all the other times is they're the number one way to play AI in China. Most amount of value for the cheapest amount. Why? Because they have equity in every single AI startup in China, because they just offer them compute credit in exchange for equity. And you're going to have things that you don't even know you own as an Alibaba shareholder wind up being thousand baggers and contributing materially to intrinsic value. That's not even accounted for, in addition to dominating cloud, compute, AI, e-commerce coming back when the middle class comes back and the higher end stuff comes in demand. We're already seeing signs of that in the recent quarter as Temu gets smashed and Alibaba maintains its share and starts to actually recover share, and all of the international growth and all the things that they put in place. So thanks for that, Dave. Thank you for all the amazing AMA questions and people contributed. Thank you for all of you who have tuned in every week over the years and offered your support. Thank you for sharing with your friends and family that love markets. That's the greatest compliment and way to pay back. If you're not a client with us, sharing it with one or two friends that could really benefit is the way to grow, the way that we can continue to do this for a long time for you at no charge. We're happy to do it. Grateful to the clients, and you should be grateful to my clients who are indirectly underwriting this for you. We do it for them, and you get to benefit, so be grateful for them. And everything else. So with that said, have an absolutely amazing Thanksgiving with your family. I'm looking forward to it. My mother's coming up. My brother's coming up. We're going to have an incredible time, and we'll see you next week. Next week, I will be out of New York City and excited to, actually, no, I will be out of Sarasota, Florida. I'll be speaking at the Money Show and also having an incredible dinner with former Governor Scott Walker on Thursday. So I'm excited for that. And we'll see you live next week from Florida. Just a quick heads up, I will be in Sarasota next Friday, Thursday, Friday, and Saturday. Any existing clients, potential clients, longtime listeners that want to meet up for a coffee, I should have a little bit of time on Thursday afternoon and a little bit of time on Friday morning and Friday afternoon. Just reach out at hedgefundtips.com, click on the contact. Look forward to meeting some of you down there. In the meantime, make it a great one. Happy Thanksgiving. Bye for now.